Everybody, Adam Parks here with another Receivables Info webinar. Today I am here to learn just like the rest of you because I've got some experts on the student loan history and how all of this has become what student loans are today. So I've got two gentlemen here with Yrefy. I have Mr. Dan Parks, no relation, although I do like to call him Uncle Dan. And I've also got Andrew Black, who are, again, both with Yrefy. Gentlemen, I've had the opportunity to get to know you at the conferences through the years, but Dan, maybe starting with you, you could give us a little background and tell us about yourself and how you got to the seat that you're in today.
Sure. Back in the day, I started in collections in 1990. It's quite a while ago, in case everybody didn't get that. Started doing my first student loans in 1993. I was working a FELP contract back then, FIA, Pennsylvania Higher Education. Worked pretty much every ed contract during my career that came up, especially starting in 1997 when I went to Van Roo and later became the COO of Van Roo. Worked every ed contract that came up. Obviously, Van Roo, NCO, FMS, every place I worked at did very well on the ed contract. So I got to know all the people up in Washington, D.C. that was running the contracts. I also worked pretty much about every GA contract that popped up, which is plus 20, I think at 26 at one time, not positive of that number, but there was a lot of them. Attended every ed meeting, met with the lenders and all the GAs. And then I joined Yrefy 6 years ago, and now we are in the business of giving loans instead of collecting on loans.
Which I'm going to dig into a little bit more with you as we have our discussion today, because this is such an interesting topic, and I think you guys are very much at the forefront of this, and I love what you're doing with Yrefy in terms of actually helping these consumers, not only to understand their options, but to provide new options to them that maybe haven't been available before. But Andrew, before we get into the history of student loans, can you tell everyone a little bit about your background?
Sure. So I started in the ARM and student loan space at the same time back in 2004. Was working on a prime Department of Ed contract. Basically stayed in student loans for many years, continuing after that first contract at Allied International Credit, went to Gates or Collect Corp at the time, working a contract there at Collect Corp. Continued working through 2014 on the prime contracts, and then kind of made some transitions within the company, working 5 different subcontracting portfolios there, and had a lot of experience on the student loan process through my period there. When I was starting the journey in the collection space, I realized if I was going to get anybody to pay, I had to know what I was talking about. And I spent a lot of time learning about Department of Education and learning about what the students knew and learning about what the common disputes and process was. And it really helped me understand and convince borrowers to trust me in what we were doing. Mm-hmm. It's been a unique experience. I started at Yrefy about little over 5 years ago, and nice to switch sides, I guess, take off what is the perceived black hat and put on the white hat. And it felt good contributing and helping these students change their direction and what was happening on the origination side. I guess when we started, we had our first testimonial. Mm-hmm. We wanted to get a borrower to help us and talk about their experience. And I was a little apprehensive at first coming from collections, what's a borrower going to have to say? But after the first one, it's been it gave me a little bit of chills to watch the real impact we had for the customer and what it was able to do. And I'm happy to see those go up a new 1 or 2 every month. And it's been a fun ride over here at Yrefy.
That's fantastic. So can you guys give the audience a little bit of background on Yrefy and what the organization does?
Yrefy started about 7.5 years ago. Really kind of came into our own about 5.5 years ago. Mm-hmm. We work with defaulted and distressed borrowers, getting them loans. We're not a big FICO score People were looking for the people that have the ability to pay and the want to pay.
Mhm.
And if we have both of those things, most of the time they get a loan. We get a lot of those things coming from referrals from a lot of the outside collection agencies, along with a lot of the major servicers working there. We also get a lot from a lot of our partners. We probably have given loans or paid off loans to well over 150 agencies slash servicers slash whatever.
Law firms, yeah.
Law firms, a lot, not anymore.
Mhm.
That's pretty much what we do. Got anything to add there?
No, I just like to say we're in the business of helping people.
Mhm.
You know, student loans have become unmanageable, and so much misinformation and lack of understanding with what they do. And it's been a fun experience getting to educate customers. And we you know, our front end first contact are advocates. They take time to understand the person they're speaking with, not just try to sell them on something or not just push them in the direction they think is right. So we focus on advocating for that customer.
I love it. And, you know, as we go through this discussion today for the audience, if you have any questions, you can put those in the chat here on Demio, and we'll be responding to those just as quickly as we can as we kind of go through our discussion today. But kind of thank you for the intros and a little bit of background on kind of the perspective that you're bringing to this discussion. Go ahead.
Yeah, one thing I'd like to add is our loans are low interest. We're not trying to put people further into debt. We're actually doing everything we can to keep them out of debt. So our highest interest rates are sub 6%.
Wow.
So
You get a card
we're trying to do a service, not disservice. All right.
It's a very interesting prospect, right? To be able to take a distressed consumer and provide them with an option that is realistic, right? That's not going to dig them deeper into debt, is going to kind of consolidate the issues that they've had and put them on that right path. But let's talk about the current state of student loans right now. How do you view the student loan world right now? What's our current state of affairs?
Well, right now, about 13% of the population has a student loan.
Wow.
And that's 1.7 trillion total, and that's growing up. Go over some numbers here in a little bit. 130 billion of that is in private, which is about 8%. We deal only with the private side, but we obviously know working on the ed contracts for so long, we know what's going on with the ed, and we try to follow what's going on so that we can give a little bit of direction to the borrowers on how they can get ahead of those and who to speak with and such. It's grown rapidly. It was 500 billion in 2006 was the total outstanding. It's 1.4 trillion now, or 1.4 trillion in 2017 when we started this. So since then, it's gone up almost 3.3 trillion.
So yeah, those numbers are growing quickly and don't show any signs of slowing down. As Dan said, when we started, we were looking at our space and wondering what kind of volume and what we could do. But now looking down, that's changing every day and getting bigger every day.
So with the issues in the student loan repayment pausing, right? Do you think that has increased the speed in which these balances are growing, or decreased that speed because there was a forbearance for such a long period of time?
I would say that it hasn't stayed at a standstill. It's still going up.
Okay. If it's a function of new borrowing, or balance is growing?
Yeah, I think that a lot of people had made decisions to borrow under the possible concept of loan forgiveness.
Mm-hmm.
And I think people who may have borrowed less amounts have felt more comfortable in borrowing bigger amounts or continuing education, because there's the hope that that money might go away, or that there's the potential write-off of that in the future. But I mean, that's speculation, right? Getting inside the student's head and what they're doing is a challenging thing to do. And that's really what
would be hard to back with facts, right? That's why I wanted to kind of lay it out in terms of, like, you guys have more visibility into kind of the loan borrowers and just kind of what your gut instinct is, based on.
Sure.
growth?
Our average balance has climbed 100% in the people we're dealing with in the 5 years I've been here.
Wow.
So knowing just that, and the people who are now looking to do something, and this was pre-COVID when we started, obviously,
Sure.
and the growth of the balance and the people who are looking for help is truly doubled from when we started.
It feels like the cost of education has almost doubled during that time period too, because if I look at the university I graduated from and what I paid on an annual basis versus what that school charges right now, I mean, I graduated in 2004 and again in 2005. I want to say the increase is somewhere around 250 to almost 300% in the cost of at least that specific private university.
Yeah, we basically have some good numbers for you here too. In 1960, it cost you about $1,000 a year to go get a school loan or go to school. 1970, or 1970, it was $2K. 1980, $4,000 a year. 1990, $8,000 a year. 2000, $15K a year. In 2010, $22K a year, and I believe that number now
35,000.
Yeah, 35,000.
Wow. I mean, I wonder if we're actually getting more for what we're spending, right? From an education standpoint, if maybe that's part of the problem that we're facing here.
Well, I think when we go to the next slide, there's kind of a history of, back in the day, people saved up for school. It was all, family money or there. And then the GI Bill came in about 1944, but didn't really take off for a little while. They wanted to make sure everybody coming back for World War II could go out and get an education, start their own business, the greatest generation, which it is. Definitely came in and made a big jump into the world.
Yeah, as student loans expanded, that's really, you can look at the increases in lending numbers and how much you could get approved for and how that changed and grew in direct correlation to the cost of education, right? It was supply and demand in the past, right? To Dan's point, you had to have the money, it had to be affordable, it had to be something that the schools were competing to get people there, and they couldn't overcharge because nobody had the funds. And as the student loans became more available, more prevalent, that's when we really start to see the cost of education rise and far exceed any growth of, inflation, vehicles, anything like that.
Any other product, any other financial instrument on the planet. I mean, it's definitely growing at a pace that is almost absurd in terms of the cost.
Yeah, that's it's hard to wrap your head around anything other than knowing that that's how the availability of student loans grew, the price of education grew. Student loans started really with our NDSL, or the National Defense Student Loan. And that was geared to get people involved in those engineering, mathematics, foreign language, those things that were going to help
with the space race.
Yeah, to help us compete in that space race or the engineering kind of fields that we needed. Over time, those loans changed and were offered in Perkins and other things to help students who needed the education, and it got away from just being the National Defense Student Loan history.
I mean, it feels like there's a much larger percentage of students that are financing their education at this point than probably ever before, right? Are you seeing kind of the same thing in terms of what percentage of active students are borrowing money versus walking in and cutting a check?
It's a very, very, I don't have that number, but it's a very, 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 very large number of people that are taking out loans instead of paying cash. There's just not that percentage of the population that can pay for their kids' schooling 100%, especially if they're
talking $35,000 a year. That's a lot of money for somebody to float.
And then that's not even counting if they go into post graduations, any type of things like that. It's adding up. I mean, we've gave out loans. We've seen loans as much as $500,000, and over the years of working Department of Ed, I even saw $1 million one time.
I don't even know what to say to that. I mean, how much
$1 million
in order to ask you
from school.
Well, we do have a question that's asking about the loan forgiveness programs, and I know that that's something that we're going to talk about a little bit later in the
certainly
discussion here. So we will address that as we kind of continue on through here. But I wanted to make sure we talked a little bit about kind of that history to where the student loans came from. And so as we talk about the history here, it started off with the kind of the GI Bill and then what eventually became the Perkins loans, but it sounds like things continued on from there in terms of how these pieces started to come together.
Yeah, I think the FELP program was a wonderful program, especially when it initiated. That was the Federal Family Education Loan Program, starting back in '65. That was money lent from banks or lenders to students to attend through the financial aid offices. The reality of that was if the student didn't repay the bank, that went to one of those guaranteed agencies that Dan talked about partnering with and trying to collect for the guaranteed agency. Most of the time were states, things like that. Eventually those funds though were guaranteed by the federal government. So the collections activities and the things that happened were maybe not as strong as they could have been, because if they didn't pay, they were 100% guaranteed that the federal government would pay back all those funds.
Kind of takes the risk out of it for the lender, huh?
Yeah, I mean, if you don't do good, you get all the money. If you do good, you get some of the money. So in 2006, the feds really pushed and went into and completed their direct lending program, where no longer could the banks issue funds. And that was a big transition. A lot of lenders, private lenders, banks, and everybody pushed hard to keep that, because that was making money on origination, then the guaranteed repayment from the feds. So that was a big change when the FELP program ceased and it was all direct lending at that point. At the end of the day, it benefited the students, right? The students were on rates set by the government. The repayment options were direct with the government, and there was no middleman in there. It was a much more robust lending program where more people could get the loans that they needed through the Department of Education directly.
The GAs that were working that business were holding on to the accounts a lot of times over the 270 days, which they had to hold on to them, trying to get collections errors, rewards, and punishments for having too many of them fall out or not get collected on, so that some of them held on to them for longer, but they had to hold on to them basically for about 270 days, and then they could sell them back to the federal government, which is what we were collecting on when we worked the ed contract back in the day. It definitely metamorphosized after what year was that? 2000, when it all went to
direct. 2006, yeah.
2006, yeah.
So one of the big things in what we've seen our growth come from is in that same period, because of the change in the banks no longer being able to write for Department of Education, they changed the private loan program. In the past, private loans had to be school certified, which means that you could only borrow the money you needed for your cost of education. And the school actually attested to how much money you needed. So when you had to go get a private loan from somebody other than the feds directly, you used to have to be exactly what you needed to fill that gap. Once they got rid of the bank lending or the FELP program, they lobbied to change and set us up so that the students now certified how much money they needed. And this is where we started to see the costs or the prices of the private loans just balloon. It's not uncommon for me to see today people who were getting a $30,000 loan every semester as they attended university or college because it was available. They self-certified. Those funds also started going directly to the student. So it didn't have to get cashed by somebody else and you got leftovers, things like that. There was a $30,000 check showing up in the mail each semester for these kids to live off of. So we now see those private loans, and that's still today running that way. As long as they had the backing, those private loans have to have, in most cases, a co-signer. So as long as somebody was willing to co-sign and do the part, you could get the money. And you simply showed a schedule and said, this is what I needed, and here's a check from these private banks giving you that private student loan. And this is what we're dealing with today, looking at some of our balances. to Dan's point, my average balance now is approaching $90,000.
I feel like that would be rampant with fraud, right? We're self-certifying.
Well, people are, there's some people that take a very liberal effect on what they can use their loans for, because you got housing, you have food, you have transportation. There's lots of things that you can
becomes everything, right? Like that becomes your living expenses. But one other question about 2006, right? Because like the government's really good at running programs. I mean, I look at the postal service and I'm just so impressed. Did you see any kind of it sounds like there was some positive effects for the consumers in terms of kind of rate fixing, which seems anti-competitive, but did you see any, was there any problems that they were starting to see through it's called federalization of that program?
Initially, no. I don't think that we've really, or even today, the direct lending program is working for most people because you have the fixed interest rates, because they're able to establish the collection and the repayment options. It's really stabilized those kids who can get it.
We haven't done a very good job within the schools, and all the way through the high school, before they go into college, of sitting down and explaining what you're going to owe and what your degree is going to pay and what's going to be your future after you do this. I can't tell you how many times we've seen well over $100,000 loans going to people with and I'm not dissing on anybody here, but for a teacher's certificate, a sociology degree, something that isn't going to probably pay or make it easy to pay back on your loans.
Fair statement. Fair statement. There's no balance of the asset that's being purchased. That's what.
And the schools, it's not in their best.
Well, financial aid officers have a responsibility to counsel on the loans and counsel on the repayment. And they sit down and they explain, here's your final disclosure. Here's how much interest you're going to pay. This is what this means. But the kid sees, okay, this is how I get to go to school, and it's going to be X payment in my future. So, having somebody actually soak that in is going to be a different option than being explained. One of the downfalls to the federalization really, though, talked about the effort it takes, right? You have to get information from your parents. We're talking about income, assets, all of their taxes, all of their liabilities, everything that's going on. And those federal loans are more challenging to get than a private loan. And so we also see people's private loans growing because the parents don't want to provide that, or they don't qualify for much because of how the details that they have to provide and understanding their availability to pay. So recently I had a customer who owed $300,000 in private loans and only $30,000 in feds. Ultimately, it was easier for the parent to sign their name to a cosigner mark on a private loan than it was to go through the FAFSA process and apply for all of the federal money that they could have received. It became just easier to get.
That's interesting, right? It's that ease of access can change how that is approached and ultimately the end cost, right? I mean, I think there's only 2 or 3 states in the U.S. that actually require financial literacy as a precursor to high school graduation, and I've kind of voiced this through the years as I spent time on a military charity board specific to special forces, because you have. They're selling them life insurance policies and all kinds of financial instruments they don't need. So I wonder how much the gap of understanding of what you're actually borrowing, other than just buying payments, right? Which is, if anyone has bought a car anytime in the last couple of years, you go into the dealership, regardless of your financial situation, they're immediately trying to sell you a payment. You can get this for $400 a month, right? It's not focused on the interest rate, what you're paying, what you're actually buying. It's, can I afford the payment? And I think that's probably part of the issue here. But how did things start so in 2008 was that change from the school certification to the student certification? Was there anything else significant that was happening at that time?
Well, I mean, obviously we were dealing with the financial crisis, or the Great Recession, if you will. and interest rates were changing, people's programs and mindsets were changing, and what they wanted to continue or the debts they wanted to get.
Mhm.
There was a dip in loans for a moment, and people were kind of holding back on going out and proceeding. But quickly after, as things started to rebound, people knew that to get a high-paying, non-easily replaced job, they wanted to go get their education again.
Mhm.
And that kind of came through at the same time, but they were relatively independent of each other in the timing. And we knew, and this was known, that this was going to happen since 2007. So it wasn't an actual cause or effect of that process.
Okay, fair enough. And so we talked a little bit about the private student loans were easier to get, and the parents on the financial aid. So, let's talk a little bit about the qualifications of the schools themselves, right? You guys were explaining to me kind of this idea of Title V or Title IV. Can you kind of walk us through what this means? Like, how are the schools being qualified to receive those funds?
So the qualification is program review. What specifically are they lending for? What are they going to learn during this process? And to be a Title IV school means that you are eligible to receive federal funds. So they've reviewed the actual details of the education, the details of the program, and the federal government believes in investing in this particular institution.
Mhm.
They can make bad investments, as we've seen with some of these schools, but most of your schools that are going to be your Title IVs are your major schools, your colleges, your universities, whether private or public. Even a lot of trade schools have programs where people walk out with an education beyond just a certification. Your non-Title IV schools are going to be kind of dedicated to a career or certificate or a cert.
Yep. Certifications, just extra schooling they want you to go through for your job. A lot of it's job related. But even Barb's Beauty College, you can get loans. Those can every now and then be Title IV schools.
Yeah, the non-Title IVs we see tend to be things like maybe lineman school or like a coding boot camp.
Okay. Less formal education, more like short order, condensed content.
Or specific to getting something, pilot school, right? So like ATP is a big pilot school around the United States, and those are non-Title IV because you're going to get a license. You're not going to get the education as compared to like an Embry-Riddle or something where you can walk away with an engineering degree while getting your pilot license. Yeah.
The engineering degree focused on aviation versus a pilot certificate or a pilot's license to fly commercially.
Sure.
Definitely a determination between those two worlds, right? So you're talking about that focus on that formal, called that formal education versus like a pilot's license, not necessarily just a career path.
Right. Your cert or licensing. So.
Yeah,
and those private schools, those private or non-Title IV schools, there's still a lot of money being lent, and those are a lot of the people we are able to help too, because we step in to refinance these, and they don't have a lot of options beyond the traditional refinance where credit's so heavily based and income so heavily based, and we're still able to help the non-Title IV institutions as well as the Title IV institutions.
I would think a lot of the Title IV or the non-Title IV loans would be like refinancing. That would be like refinancing a car or a credit card debt or something else, right? Like they're not going to have the same kind of advantageous opportunities for refinance.
That is a fact. They're going to have to go traditional.
That's tough.
And
it's never easy.
It's going to be FICO based.
There's still student loans, so they still maintain, because they're issued through the Sallie Mae or whoever might be issuing. They're a big lender for those types of institutions. So there's still student loans. They're still typically bankruptcy exempt for the borrower and the institution. So it's not something that they're able to discharge like it would be a credit card. It's still a student loan, so it still maintains a lot of its protections. And the student still is going to be obligated for repayment beyond maybe what they might think a credit card is. So.
Okay, fair statement. So as we talk about the subsidies of these schools, right? And how ultimately some of these loans are being subsidized versus non-subsidized. Can you kind of walk me through the difference between these and how they affect the borrower?
Sure. So subsidized loans are the preferred loan. Those are going to be, the word subsidized is referring to the government is effectively offsetting the interest accrued while you're in school. So you're not accruing interest while you're in school or in your grace period following school. Those loans are not accruing interest. So the amount you borrow today will be the amount you repay or start repaying when you graduate or stop attending more than half time. So those have typically lower limits and better rates, but you don't qualify for as much. Secondly, we'll have an unsubsidized loan, which if I get an unsub loan in my first year of attending, during my entire attendance of school, that loan is sitting there accruing interest while I'm still in school during my 6-month grace period. And when you walk out and you start to repay, you're now looking at a loan balance that you didn't borrow initially. And that really changes what people's budgeted. And when you were sold a payment, when you started enrolling, now that payment's changed because the amount of money you're paying. And looking at time of education extending 5-6 years isn't uncommon. Those loans have, drastically gone up. Private loans are going to fall into like an unsubsidized category. And due to typically prime plus, right now I'm seeing interest rates on a lot of our private loans and that we're looking at in that 12 to 18% range. So garnering that type of interest for multiple years while you're still attending school, these loans will come out and they've doubled by the time they go to start repaying. So you borrowed that $20,000 and now you owe $40,000 or $35,000 when you actually go to sit down and start paying. So that payment that you were sold and promised has definitely changed.
Okay.
Subsidized are more for the lower income people. They are able to get into those loans a little bit easier. Well, a lot easier than somebody whose family, because we look at household income. And if you have anything of substantial, you're not going to get a subsidized loan. It's all going to be unsubsidized.
Really? So if you have any assets or you are, you've done fairly well for yourself, the probability of getting a subsidized loan is decreased.
Yeah. And they look at your household.
So, am I understanding this? So basically the lower your credit risk, the less likely you are to get a subsidized loan.
Yeah, lower risk.
So as a person of financial means, right? Like the probability of getting subsidized is decreased exponentially.
You'll qualify for less,
even though you're a lower credit risk from a repayment standpoint.
Yes, and you may be looking at needing to do parent plus loans, where the parent is actually the primary borrower in that scenario, where the parent's responsible for the repayment. So those parent plus loans, there's some confusion in kids who go in and, hey, mom, sign this parent plus loan. You're co-signing. Well, that's not the fact. Parent plus loan is a loan for the parent, not for the student. And the student is the beneficiary of it, but the parent's the one with the financial obligation to repay that loan, not the student. And
so
those, again,
not being a co-signer, that's being reported directly to your credit, that's showing up in your balance. It's having a negative potentially effect on your credit score, even if you're repaying it because of the even on that installment early on, it's going to be kind of reducing your credit score.
Yes. And, kids are, well, I'm going to pay that. Well, they don't. The parents aren't paying attention to the fact that this is their loan, not the kid's loan. So get some, talk to some confused and upset parents over the time about this because of the promises they were made from their kid, and it changed, right?
Sure.
And federal loans are obviously the way to go for anybody who's looking to proceed in their education right now, because those are going to be fixed rates, lots of programs, lots of options for the student or the borrower for that matter. And when you look at private, those variable interest rates, longer terms, and not going to be you don't have those federal programs to repay basing on income or career path.
If you default on a federal loan, you have lots of options. You can do a rehabilitation, you can do a consolidation. Sometimes they'll allow you to do more than one back in the day. It gives you lots of different ways. If you quit paying on your private student loan, it's no different than not paying on your Discover or Visa card. You're in collections, and you don't get out of collections until you either get another loan, settle the account, or pay off the account, which means if you're making a minimum payment on use an example, $10,000 loan, and you're making $100 payments and you're in collections, you're in there for 8.3 years. It's going to show on your credit report because it doesn't show until it's all paid off. It doesn't change.
Interesting. So once you've gone into collections, you're not seeing, it's not
Same thing.
going to bring you current on that student loan.
That's
trade loan.
the same thing on a credit card or pretty much anything else that's in active collections.
I kind of lead us into that next slide that talks a little bit about the recovering and how.
Well, I do have one more question though on that last one. You mentioned variable rates, right? How or what percentage of student loans would you say are sitting on a variable rate? I feel like that's kind of, unless you're forced into that, that's kind of not a great situation for people that took loans over the last 10 years.
So when we talk about private student loans, almost every private student loan we deal with that's not a refinance, like an originated to go to school private student loan, is a variable rate.
Really?
All the Fed loans are fixed rates, and so those private loans, it's up to the lender and when they adjust, how often, quarterly, semi-annually, annually.
Sure.
But those are going to be adjusted based on prime rates. And the only time we see a private loan with a fixed rate is going to be somebody who did a refinance and went to a company like a Yrefy and was able to get onto a fixed rate loan. Okay. Where now there's financial stability, right? You know, same payment, fixed rate, fixed payment, fixed term.
You know what you owe and you know what you're going to pay.
Well, we saw what happened with ARM mortgages, right? So I just wanted to try to understand how that cause and effect might come together.
That definitely pushed a lot of people to us when interest rates changed, because they started looking down saying, okay, well, my $400 payment's now $700. Yeah. And I didn't do anything different. I just woke up and I got a new bill. Mm-hmm. And that's some of the higher balance people needing to make a more immediate change because they're feeling that effect, right? A 6-point jump in 100K is a lot different than a 6-point jump in 25K.
Sure.
So those have definitely pushed a lot of people our way with the higher interest rates.
Are student loans amortized differently than, I guess a credit card? Are they amortized like a mortgage where more interest is paid up front, or is it more of a neutralized amortization?
It's a standard amortization. Obviously, that can be detailed in a promissory note, so that can change on lenders. Sure. Typically fees, accrued interest during that period, and then principal. Okay. But the amount that you're told your amortization would be is going to change because of the interest you're accruing during the period of enrollment. Okay. So when you graduate and you look down and you're like, okay, I have a 180-month term. Well, I started with 15K and now I owe 25K. My monthly installment on that's changed. And your new budget to learn, it's a new process to stare at and a new way to approach the loan. And that's shell shock for a lot of these kids.
It's very interesting. So I appreciate your clarification for me there, because again, I'm learning so much about student loans through this discussion.
Sure.
Even though I had student loans, right? Just kind of understanding how others are viewing it. So let's talk a little bit about the recovering of student loans, since both of you have sat in that chair for quite some time. Help me understand, what does the recovery process look like in the student loan sector?
Well, everybody works it within. If we go back to the GAs, they worked them in-house, and then they started. Some of them would use agencies to collect start before it's actually getting close to being charged off, 1 to 3. Then by the time they got to 6 months, most of the GAs actually put them into collections, and those went out to a variable of the larger collection agencies back in the day. Worked all these accounts and worked on the collections. The Fed would go up to contract, and it would vary. There's been as little as 4 and as many as 24 agencies working them at the time they go up for bid. It became the biggest thing there was in collections. Was to get that ed contract, and the ones that got that ed contract certainly did very well for a long period of time.
Sure.
You know, the whole idea of the VAT was, and the reason why the Department of Education was actually one of the more well-ran agencies in the federal contract is there was just a VAT. You gave out money out of that, people paid it back in, they had to pay their interest, filled up the VAT, more people were getting loans, school loans, and then it kind of went. And then we basically about 18 years ago, we quit trying to collect on student loans. We tried to help out borrowers. We quit trying to, and that got empty.
Mm-hmm.
And we are continuing, I don't want to get political or anything else, but we're continually trying to pull that out even more so. Before that, everybody expected to pay fully on their student loan.
Sure. And so it wasn't until much later, and we're going to talk a little bit more about the loan forgiveness programs and, you know, how that may have an effect not only on, you know, the expectation of repayment, like we talked about, how it could be contributing to the rise in balances and borrowing from an education perspective, with the expectation that I can get something and not have to pay for it, which I think is an issue. But talk to me a little bit about the consolidations versus the rehabilitations, because I've heard stories from student loan, you know, recovery groups over time talking about being able to get people into these rehabilitations and the various programs and kind of how that was ultimately compensated by the federal government. But help me understand what that process actually looks like in terms of the government trying to help a consumer resolve that outstanding account.
Certainly, and you know, it all started with cash collections, trying to generate as much cash as you could. And then eventually they migrated to a consolidation program where borrowers could make 0 pay, 1 pay, 3 pay, 6 pay. It varied over time and fees you would receive to sign people up. And ultimately they'd make a series of payments or no payments, fill out paperwork, submit that to the Department of Education, and they would effectively refinance that debt. During that refinance on a consolidation, all of the collection cost and interest that had accrued on that debt during that period was capitalized and became part of the principal. So the debt was made up of many pieces, but once you did a consolidation, all those things are paid off, new loan for the total amount that you owed. Mm-hmm. And that was a great program. A lot of people were able to get out of debt. A lot of agencies did well in collecting on those. And over time, they transitioned to the federal rehabilitation program. Initially, the rehab program was based on effectively the borrower making a series of payments at a percentage of the debt, showing that if I paid 1.29% for 10 years, that would amortize my debt. Mm-hmm. And it was a way to show and prove their viability to get out of debt and get that fresh start with Department of Education. Mm-hmm. Once that changed, where it then became income-based, that changed the payments that people had to make, and people could make as little as $5 a month for a series of payments and get the same benefit. So they make a series of payments, submit some paperwork to prove their financial situation or attest that they're enrolling into this program. Once they completed that, the loan would rehabilitate. Mm-hmm. The negative trade lines would be updated on the credit report, and they would get a new loan minus the collection fees. So this was a little bit of a break from the consolidation, where the collection fees were part of the new principal. It didn't include the collection fees. The student then had a brand new debt and was able to just continue making payments. So in the scenario where they fell on a hard time and that lasted a year or two, prove to the Department of Education your sincerity and your ability to make these payments, and now we're going to give you a fresh start. And that's really the last of the big benefits for the collections and really how it was running until we stopped collecting.
And it's actually still, rehabilitations are still active, and as is consolidations. When rehabilitations came in, we were looking at getting 3 payments from borrowers.
Mhm.
When it moved to rehabilitations, the sky was falling. It was either 12, but then it moved down to 9 months, and then it moved down to nine months, but they could miss 1 month, and there were set dates that they had to make. They just basically had to prove that they're ready to start making payments on it. And then later on, it moved down to low income contingent, basically.
Mhm.
And it would go down to as low as $5, which happened to be probably the normal number, which most rehabilitations were being done. And then once they got through the rehabilitation, got current, they had to still prove that they were income deficient to continue making that payments.
But it sounds like it was like a behavior demonstration, right? You had to demonstrate a specific behavior over a specific period of time in order to receive these benefits.
It's exactly what it was.
Okay.
It's exactly what it was.
I mean, which actually seems fairly reasonable, right?
Logical.
Behavior-based, at least on some level. I mean, a $5 payment in comparison, I guess each individual loan is different, but just something to kind of consider there. Now, let's talk a little bit, and I know this is where the audience really wants us to go, but let's talk about how COVID changed everything, because it did have, a direct effect on student lending and student loans in general. So let's talk our way through that a little bit.
Yeah. So ultimately, we're talking about in March of 2020, the Department of Education put loans into a non-interest bearing deferment or hold for an undefined amount of time. When we did this, people said, woohoo, don't have to pay. Average student loan payments around $400 a month. And it was a mentality shift for a lot of people that this debt's not a responsibility. And initially, it was probably needed, right? There was so much uncertainty in how the world was going to behave and what was going to happen and job losses. It was a big shakeup, right? And I think it came from a really good place when it started. Over the time, the longer somebody doesn't have to do something, the worse they become at doing it. And when you take somebody and you're asked to not make a payment for 4 years, your ability or your, practice at it starts to wane.
The behavior
It wasn't like half the people went unemployed. You can go as high as 10% or whatever it is that COVID changed, lost their jobs, whatever it is. But the fact of the matter is, you take a young adult and they're used to paying $400 towards their student loans, and all of a sudden we stop that. Matter of fact, we quit taking
and you had money injected in on
you
top.
had to call them up and say, I want to continue making my payments. If you're a young adult, all of a sudden $400, I'm getting a new Skidoo, I'm getting a new motorcycle, I'm getting a nicer car.
Look at the car market, right? Look at the car market over the exact same period of time and say, how did the prices artificially inflate so dramatically? Right? Yes, there were supply chain issues, but the only thing that could drive that demand to that level would be the availability of money. So if you take away the $400 a month payment and you add some stimulus money on top of that, where does that leave the behavior of the consumer? Right? Like that whole behavioral pattern has now changed. And the expectation has changed over an extended period of time.
Which is why businesses did so well during that time.
Yeah, the arm industry in particular, had some stellar years.
Because everybody had a little extra money to pay on things.
And in some instances,
it was decent collections back in the day during that.
Well, it's also buying that payment, right? So if they're out there buying that payment, they got that extra $400. They were already spending $400. Now they can go buy that BMW instead of that Ford.
And as the thing said, 8% of people were making payments on their loans, on their student loans.
Consider that 8%, 92% chose to take the forbearance and not reduce.
Didn't choose. It actually wasn't even a choice. In a way, they quit you had to go and say, I want to continue making my payments. You had to actively do something to do that instead of just having it continue to happen.
some people recognize, and that 8% recognize that I'm getting zero interest. So I could make a payment for a period of time where 100% of my money is going towards principal.
Sure.
And I can pay off my loan really quick.
That wasn't the rule, though.
Well, right. I mean, you didn't have to. And then, so there were some people, but only 8% saw that as the opportunity, right? And I think that changes the mindset in student loans we hear is most people want to pay on student loans, not pay off student loans. And I think that's where people started changing. Also, we had several of the TIVAs or the loan servicers at the time were going out of business or quitting because they saw the writing on the walls that this isn't going to be a productive business venture for me. So loans were transferring from servicer to servicer. I mean,
long wait times trying to find out where your loan was. I've heard nightmares of people just being on hold forever. And you couldn't even find out where their loans were to even take care of. They didn't know where they were. I mean, it was
Sounds like 2008 mortgages.
for sure.
Yeah.
And then
Right? It's the disarray to the marketplace.
you go and couple that with the introduction and talk of student loan forgiveness, which, you know, now that 8% is struggling because in their mind, there's a chance this is going to go away. So if I'm paying today, will I get my money back? Is it best to pay today? Are my loans going to be forgiven? And that's where I think we really started to continue to distract from the idea of you got your debt, pay your debt off, and move on with life.
You could certainly get the thought process of, and I'm not going to lie, I have kids that I took out Parent Plus loans for things like that. And I questioned myself, should I pay these loans or should I wait for them to be forgiven?
I had the same question.
How are we going to do this? I mean, there's lots of different things that go into this whole thing of loan forgiveness. What about the people that just paid off a loan? What are you going to do for the future people's loans? You know,
and what does it do to control the cost of education?
Never ever even got discussed, or which are the two biggest things. What about the people that just paid off their loans?
It was clear
they're penalized. And what about the people that are just getting about ready to graduate?
So they were pretty clear with those that had just paid off the loans and that there would be no benefit. There was no tax rebate. There was going to be no benefit for anybody who paid off the loans. And for those of us with really low interest rates who, you know, went to school in the early 2000s, and with rising interest rates, the question becomes, what do you do? You sit tight? Do you pay it? Like, what's the benefit going to be? And I think the idea of the student loan forgiveness in general is, where does the cash flow come from, right? Or those that did not attend school at all and went into the trades, you know, how does that start to balance? Where is the equality that we're being told is so important?
And that's, I think, comes down to so much of this is just people say student loan forgiveness. Well, there's different types of student loans, right? You have federal student loans, you have private student loans, you have Parent Plus loans, you have sub, unsub, so many different student loans. And for grandma who's watching the news and says, well, I would love for Timmy to not have to pay his student loan, so I want this. But the reality with only 13% of the population having a student loan, and maybe we'll be generous and say 50% of those people are like intimately familiar. So few people understand what a student loan is or how forgiveness may impact that. It's easy for us to be distracted or to pay attention to these words when, I had an experience watching a YouTube recently, and this lady was on and saying, if you don't believe in student loan forgiveness, you just want the banks to make buckets of money. And I look at that and I said, what?
Yeah.
The banks there's no money in a bank with this scenario, right? This is taxpayers that are going to float this because this is federal funds. There's never been
generally a great place for financial literacy content.
for sure. And they got a YouTube channel, right? So and there's never been a talk of private or a mass private student loan forgiveness. And that's where we're here to help the $130 billion in private student loans find a way to ease the burden, right? Take some of the pain away of the scenario.
There's been a lot of great headlines for the forgiveness of loans, all the
Sure.
drive, all the IT.
It makes a sexy headline.
A lot of the art institutes and everything else. And when you hear a number like, 300 million of loans forgiven and everything else, it makes a great headline and people are, oh my God, that's a ton of money. Well, compare that to 1.7 trillion and divide that into there. It isn't, it's a cup of water out of the ocean.
So let me ask you this. So as I've kind of listened to the whole debate, and we've only got a few minutes left in our discussion here, but as I've listened to the whole debate about student loan forgiveness, the one thing that I have not heard anybody talk about yet is the cost of education. So we're going to forgive these loans, but we're not going to address the root cause of the rise in balance. Have you guys heard anything about controlling that cost of education, or are we just going to turn a blind eye to that and use the sexy headlines?
Number two, I think, is the path that we're seeing today. Educational reform is an option, right? Changing pricing, whether that's for in-states, and some states are doing a good job at this, but in general, there isn't a lot of talk about fixing the cause of the issue, right? We're just going to put a new Band-Aid on the bullet hole, and nobody's really willing to address that because that's money making, right? Those are state ran, that's state money, that's state cash. So I think it's we're just not seeing that. And the reality is, I believe that would be the best place to start versus forgiving anything. Let's start with fixing the actual problem, right?
Controlling the cost. And, I just saw a comment come through in the chat from Lou DePalma, who I highly respect and very knowledgeable about the space. Private student loans should be the focus of the receivables management industry. Private student loans are a $130 billion market, $3.5 billion of charge-offs per year, $400 million investable. The private market borrower is much better buyer, and there is a higher percentage of creditworthy co-borrowers. Lou, I think you're on point.
That's a fact. And again, this next election is going to let you know which way things are going to go as far as that goes. It's going to go a lot more the way Lou sees things. If the Republicans are successful in getting in, it's going to go the exact opposite way if the latter happens, which is going to be a bigger burden on the taxpayer. Not to get too far into.
No, I think it's lining up just to be quite that way. But coming into the final minute of our presentation today, let me state that for anybody that's watching, if you want to have a chat with Dan and Andy, you can find them at the conferences, right? You'll see them at the TU Summit in August. You'll see them at DCS in early October, and you'll see them again at the National Creditors Bar Association Connect Conference at the end of the year, towards the end of October. But I highly suggest, if you haven't yet, stop them in the hallways, have a chat about student loans, because we're barely even breaking the surface of, I think, the discussions that we'll be having about student loans over the next year. So, gentlemen, thank you so much for coming on and sharing your expertise with me. This has been absolutely fantastic.
Always a pleasure to
Appreciate
speak
you
with you,
having
Mr.
us.
Parks, and
Yeah.
everybody that joined us.
Thank you.
Please feel free to reach out to us anytime. We're easy to be found, so contact us at Yrefy.
And for anybody that is watching, we really do appreciate your time and attention today as well. We will be putting this up on YouTube on Friday, so please go share this with your friends that also should be learning about student loans and how they are living within the receivables management space. But until next time, everybody, thank you so much. We really do appreciate you, and we'll see y'all again soon.
Cheers.
Thank you.
Thank you.